Good morning. My name is Tim Nyland, and I'm the Director of Research here at Pacific Point Advisors. 2024 continues to deliver S&P performance driven largely by the growing risk of technology sector concentration. As we celebrate the second anniversary of the current bull market in equities, it is easy to overlook why the Pacific Point stable earnings portfolios are such a critical component of core equity portfolio allocations. Over the next 5 minutes, and within the context of performance results through Q3 of 2024, we're going to review how stable earnings portfolios work and why. Then we will wrap up with a quick review of the effects of technology sector concentration on valuations for the stable earnings core, dividend, and ESG portfolios. Let's get started by answering the question, why stable earnings portfolios for core equity allocations? Stable earnings portfolios are engineered with the intent to deliver long-term equity market returns, or better, with lower volatility, lower drawdowns, and reduced exposure to economic cycles and equity market concentration. Stable earnings portfolios are designed to be less volatile and a less emotional investment experience. It is not necessary to try to time entry into and out of the market. Investors can confidently get cash and T-bills off the sidelines and invested in equities. Stable earning strategies are easy to understand. They are low turnover, high conviction strategies with 25 to 35 individual stocks per portfolio. There are no derivatives or exotic financial instruments used in the construction of the portfolios. The easiest way to understand how stable earnings portfolios achieve market returns or better with lower volatility and lower drawdown is to observe portfolio versus benchmark price and earnings trends through multiple economic cycles. The following 25-year chart illustrates the price and earnings comparison of the stable earnings core portfolio in the top panel versus the S&P 500 in the bottom panel. Note that each of the prior 3 business cycles are separated by recessionary periods, represented by the areas shaded in gray, with EPS represented by the orange line and price represented by the blue line. Note that the stable earnings core portfolio in the top panel chart exhibits a desirable high EPS stability with low price volatility. The conclusion here is that earnings stability throughout economic cycles can buffer price volatility and can actually limit drawdown versus the resulting volatility and drawdown illustrated in the bottom panel S&P 500 chart. The advantages of stable earnings can go far beyond the possibilities of lower portfolio volatility and lower portfolio drawdown. EPS stability can also impact the long-term annual growth rate of portfolio EPS, which in turn can influence portfolio returns. Over the prior 25 years through Q3 of 2024, the average portfolio company in the stable earnings core portfolio has grown underlying EPS at 13.34% per year, which is 2 times the rate of the equivalent market cap weighted average stock in the S&P 500, which only grew earnings at 6.62% over the same time period. Can you guess what your returns would look like if the earnings stability within your portfolio's core equity allocation afforded you the ability to achieve long-term earnings growth that averaged 2 times the S&P 500 each year through multiple economic cycles? We will revisit this question in just a minute. The following table illustrates why stable earnings works as a core equity allocation. Note the beta column. The portfolios are designed with the intent to deliver a reduction in systematic risk as measured by beta versus the S&P 500. Recall that the beta for the S&P 500 is 1, so historically the risk reduction for the stable earnings portfolios has ranged from a 31 to 44% risk reduction for stable earnings core and dividend portfolios to an 11% risk reduction for the stable earnings ESG portfolio. Note the annual EPS growth rate 25 years column. Across the family of stable earnings portfolios, this annual EPS growth has averaged between 50% to 100% greater than each of their respective benchmarks. The following chart illustrates the stable earnings core portfolio since inception as an SMA strategy through the end of Q3 of 2024. Stable earnings core portfolio is in blue and the S&P 500 is in black. Note the cumulative net performance since inception is roughly equal. However, there are great differences in how these returns were actually achieved. Here you can see the effect of the stable earnings core portfolio's reduction in risk, evidenced by the drawdowns that are roughly half during periods of extended S&P losses. In addition to achieving this headline risk reduction, stable earnings core portfolio returns were achieved while being underweight the technology sector on average by more than 50% versus the S&P 500 over the same time period. Since inception, investors received the added bonus of achieving market returns without the ongoing technology sector concentration risk. Remember a few slides ago when I asked you if you could guess what your returns would look like if the earnings stability within your core portfolio equity allocation afforded you the ability to achieve long-term earnings growth that averaged 2 times the S&P 500 each year through multiple economic cycles. Well, the following illustrates the net cumulative return for the stable earnings core model portfolio versus the S&P 500. And this is actually 15 years prior to its inception as an actual SMA strategy. Since earnings are commonly referred to in our industry as the lifeblood of equity valuations, it should be no surprise that a portfolio whose underlying earnings growth can average 2 times the S&P 500 each year through multiple economic cycles can then outperform the S&P 500 by 2 times over the long term. The following charts illustrate that technology stocks have pushed market capitalization concentration to the highest levels in 60 years. So keep this slide in mind when you are considering the concentration risk present in the S&P 500 and other broad market equity indexes. Recall from a previous slide that since inception, stable earnings core portfolio returns were achieved while being underweight the technology sector on average by more than 50% versus the S&P 500 over the same time period. And that this reduction in technology sector concentration risk was in addition to the 30% systematic risk reduction as measured by beta. We can translate the previous concentration slide into the year-to-date performance contribution to the top 10 stocks. The following slide illustrates how the technology sector concentration has actually influenced the year-to-date total return contribution to the S&P 500. And you can see over to the left that 9 stocks basically comprise 35% of the contribution to the S&P 500 year-to-date. NVDA actually makes up 22% of the year-to-date total return contribution to the S&P 500. And that the remaining S&P 500 stocks only constitute 43% of that return. So what does this mean? If you're using the SPY or related broad market ETFs as all or part of your core equity allocation, remember that this technology sector performance contribution is a knife that can cut both ways in good times and in bad. With stable earnings portfolios present as your core equity allocation, you can mitigate this growing concentration risk. If you think you can circumvent the concentration risk in the SPY and other broad market ETFs by using sector spiders or other specialty ETFs, please be aware that the market capitalization weighted construction of many ETFs has pushed concentration risk to surprisingly high levels. Here is an example of the weight of the top 2 stocks in each of the S&P 500 sector spider ETFs at the end of Q3 of 2024. And keep in mind that this is just one example. When we talk about portfolio valuations relative to benchmarks, it is important that we consider the primary drivers behind the tech/market rally that has taken place over the past 27 months. During this time, equity markets have experienced a massive valuation expansion driven by the passage of the Inflation Reduction Act in August of 2022 and the subsequent $5 trillion in government spending, followed by the debut of ChatGPT in November of 2022. As we move through the next several charts, you'll want to keep your eyes focused on the Q3, Q4 2022 time periods circled in black. These time periods are shown in the following chart to illustrate the magnitude of recent increases in total U.S. debt, which have been stimulative in nature, helping to prop up the economy and propel the AI rally, pushing the Dow, the S&P, and the NASDAQ to record highs. Since the passage of the Inflation Reduction Act and the debut of ChatGPT, the S&P 500 technology sector valuations measured by the PE ratio have doubled to more than +2 standard deviations from its 20-year mean. The technology sector appears expensive at these levels relative to its own historical average. To go back a full 25 years with technology sector valuations, we can normalize PE ratio valuations for the presence of negative earnings during the dot-com era by shifting our focus away from the PE ratio in favor of the price to sales ratio. You can see that since the passage of the Inflation Reduction Act and the debut of ChatGPT, S&P 500 sector valuations measured by the price to sales ratio have also doubled to more than +3 standard deviations from its 25-year mean, putting current valuations on par with pre-dot-com level technology sector valuations. So how do the valuations for the stable earnings portfolios compare, since they are significantly underweight technology sector concentration? The following chart illustrates that the increase in the S&P 500 technology sector concentration has pushed the relative PE valuation of the stable earnings core strategy to trade at a discount of actually -2 standard deviations below its 10-year average PE relative to the S&P 500. A different way to look at this is that relative to current PE valuation for the S&P 500, the stable earnings core portfolio is the cheapest it's been in the past decade. Shifting our focus to the stable earnings dividend strategies and ESG strategies, you can see that relative to the S&P 500, they are also as cheap as they have been in the past decade. We believe current valuations offer an attractive entry point for new allocations into the stable earnings family of core equity portfolios. We invite you to reach out to us to learn more about the peace of mind that stable earnings portfolios can bring when they are at the core of your equity allocation. Thank you all for attending.